Good afternoon, everyone, or morning. We've already spoken a lot about the common connections between the UK and India. I think cricket is certainly one of them, which hasn't been mentioned either. And my phone keeps pinging to tell me that, unsurprisingly, the second Test match, West Indies and England, have been postponed by rain. Also, Jofra Archer didn't obey some of the isolation rules, has been chucked out of the squad. So not very clever. I'm just going to share my screen and hopefully this will work. There we go. Right. So I'm just going to go through some practical steps really on setting up a business in the UK, and actually what are the practical implications of actually running that business then afterwards. So just a quick introduction again. My name is Ian Matthews. I'm a partner at Kingston Smith. We have an India group which specialises in helping Indian businesses set up in the UK. It's been in place for 30 years, but it also really looks after Indian businesses which have existing UK presence. So that's just a little bit of us. So I just want to go through this timeline. So these are the sort of things people need to think about when planning to set up in the UK. It's not just about setting up in the UK and running, it's actually making sure the right structures are in place beforehand. And a nice little plug here for Antonio. The first thing to consider really is who you're going to send. What is the team that's going to operate in the UK? What are their immigration needs? What are their personal needs? So what sort of planning do we need to put in place? Is it that you want to send your own team, a representative of your team to the UK to run that business, to set it up and to grow it, because they understand the culture, the business and everything which is great about it? Or do you want to recruit someone from the UK who knows the market, the local market much more? Unfortunately, there's not one answer for everyone. It is always going to be on a case-by-case basis. But once you've made that decision, it will inform a lot of the decisions you make later on. Looking at the sort of structure that you actually need, that you'd want to create, there are lots of different business structures in the UK, very similar to that in India. I do appreciate that while the majority of people here are speaking from businesses in India, there are a lot across the rest of the world as well. So I'll be happy to pick up more country-specific points later, but I will be focusing more on the implications for India. The main two structures to really consider are setting up a subsidiary, so a limited company, 100% wholly owned by an Indian parent company, or a branch. A branch is literally a division. It's its own entity. It's an extension of the Indian parent company. It just has an office effectively in the UK. Once that decision's been made, it's all about then setting up all of the regulatory requirements. So opening a bank account actually is probably the hardest thing to do on that slide. But actually it's discussing with people like from the DIT and ourselves about the best way to do that. Registering for certain regular taxes, so payroll taxes such as PAYE, sales-based taxes like VAT, similar to your GST, and also the employment side of things. Once you've set those up, you're registered for those taxes with the UK tax authorities, HMRC as they're called. It's all about then reporting to them about those taxes on a regular basis. So quarterly VAT returns, monthly payroll reports. There are also annual requirements, so just like in India, filing statutory accounts. Some of these are required by law to be audited, some are not. And a lot of that will depend on the group position. So in the UK, it's whether or not a UK subsidiary requires an audit depends on the worldwide position of employee numbers, turnover and gross assets. Corporate tax, UK permanent establishments, both branch and companies, are taxed on their profits generated by either the UK company or by the branch. That is filed annually. And there's also then a statutory form to talk more about the statutory changes in shareholders and directors, and to say whether there's been any changes from last year. So, yep, that's a key things to maybe consider. Looking at the business structures then. So, as I say, that there are two main points, one being the limited company, one being a branch. There are others, as I mentioned on the slide. Again, very similar to the sort of structures that you'd find in India. So what are the main differences between a branch and a subsidiary? The main difference is limited liability. So the actual company in the UK, its obligations, its creditors, etc., they're limited to that of the subsidiary. If, let's say, you built a widget and you offered a warranty and something goes wrong and there's an accident and the legal action is started against the subsidiary, it's against the business. As a limited company subsidiary, it is wholly the UK company's issue and concern, while the branch, being an extension of the Indian company, it's the Indian company's liability and their legal case. So it ring fences liability quite nicely. The other things to consider on that point of view is that sales contracts, for example, if you do have a sales contract, if it's in a company, it's the UK company that is the provider of that contract to your customers. As a branch or permanent establishment, it's the Indian company. It's just an extension. The perception of a limited company very much is you're there, it's bricks and mortar almost, even though you don't actually physically have to be there, especially at the moment, compared to that of a branch. Disclosure, the level of disclosure is different. So in the UK, it's the subsidiary, the UK company discloses its accounts on a free public register, which is available online, while a branch, because it's an extension of the parent company, of the actual Indian company, it's that company which has to file its accounts publicly. Now, that may or may not be a persuader on either side. To give a well-known example, TCS is a branch in the UK. It files the TCS audited accounts in the UK and it's publicly available. But at the same time, it might be the case that you don't want to over-disclose all the information which is available in the parent company, in the home territory. So certain things to be considered there. Speed. Now, this can be a very important piece. If you want to hit the ground running, you want the business set up, you want to be able to actually run as soon as you land. Setting up a company, very, very quick. I know Vikram mentioned 5 days. Actually, what we've done for a number of our clients is we'll do all the prep work up front, because it's the KYC procedures which actually take the longest. It's just verifying all the documents and getting them notarized. But once you've done that, if your representative lands at Heathrow at 9 o'clock in the morning, you email me and I'll press the green button. The company's actually incorporated by lunchtime. It can be that quick. A branch on the other side is not. A lot more paperwork, a lot more disclosure about the actual Indian company has to be made. It is a lot, depending on the complexity of the Indian business, depends on the length it can be processed. And actually, as I say there in the slide, it can actually take around a month. So still not a long period of time, but it can be a persuading factor on which way to go, depending on your target market. Branch requires a UK representative. You have to have someone in the UK for a subsidiary in a company. You don't. And actually, this is a regular question I get asked a lot. The one thing to consider is actually who manages that company on a day-to-day basis. If all those management decisions are made in India, there is a risk that actually the company its place of effective management is in India and actually should be taxed in India. Or is it actually all in the UK? And there are steps and there's considerations to be made, but it's just something to be made aware of. Quite a lot of my clients, they may have a UK director, but they'll have a lot of their board still still in India. And that does help with opening a bank account as well. Having a UK presence does help speed things up. So that's that one. So you've set the business up, you've put your team in there. So how does that work? Well, like everyone, they get taxed. In the UK, it's like any other country. It is the company's responsibility to tax the individual, deduct the tax source, pay the net salary to the employee, and pay the taxes over to HMRC. I won't go through the figures there, but there's a feel there of what the tax rates we're talking about. For an individual, anything up, basic rate up to about £50,000 really. It's 20%, everything up above that's 40, top level 45. There is social security and national insurance, which is something as an international business, perhaps seconding employees to the UK, I'll touch on in a sec. But it's a tax on the individual. Apart from there is an employer's element, a tax at 13.8%. So that's an additional tax on the individual, on the company, sorry. So it is a cash flow restriction. But the salary and the employer's national insurance is tax deductible for corporation tax. For seconded employees, there are a whole range of reliefs available. So actually you can manage the cash flow very much, depending on their individual situations again. So if you're looking to send someone over and it takes 2-3 years to actually really bed in operations, these are certainly things to consider. If it's just if they're not going to be resident in the UK, so they're less than half the year, 183 days, and less than 60 days at any one time, they can apply for just being a short-term business visitor, and so they're employed by the Indian parent still. They're paid by the Indian parent company still, and they're taxed by the Indian parent company still. Touching where we see a lot of opportunity for Indian businesses to really help their talent reduce their tax bill is the social security, that national insurance I mentioned. So actually a lot of companies have an automatic exemption for seconded employees if they apply for it. So that's somewhere between 1 and 5 years. The automatic is a year, which applies to India, and Moore Kingston Smith, we're a huge advocate, and we're talking to the government about, especially post-Brexit, trying to get that social security agreement to extend that to the likes of Canada and the US, where it's 5 years. So that means there is no national insurance to pay on the employer or the employee. There's then overseas workday relief. A lot of our clients, they'll second a member of staff to set up UK operations, where's the base, but it's actually for the wider continent of Europe. So actually they'll spend 3 days working in London or wherever, and then 2 days they'll be going to Frankfurt or Paris. So for that first 3 years, that individual is only taxed at income tax rates on those 3 days, the days they are set in the UK. Again, there's applications and processes to be made, but that is a relief available. And finally, the temporary working place. The individual seconded, actually, they're having to spend a lot of the salary they do get on paying for rent. Now, the one stipulation I would say on this, you do get a deduction off your gross salary and you're taxed on that net amount effectively, but for 2 years, but it has to be on a reasonable basis. So if you're paying for a penthouse flat overlooking Hyde Park, I'm afraid that full amount will not be deductible for tax purposes. If it's an apartment in South London, still very nice, but not excessive, yes, you can. That rent and that living cost can still be deducted. I won't whiz through this. It's very much just a demonstration. So each column, that's your standard position. What if we apply for national insurance exemption? What if we applied 40% as overseas? And what if we also did a £1,500 a month as a deduction for living allowances? The key figures there to really look at is on the net salary to the employee and the net cost to the employer. So based on a salary of £45,000, a fairly regular standard salary for a lot of our ICT secondees, actually you'll see that there's a huge saving there in tax available. Other things considered on talent, UK employment law, a contract does need to be in place. There has to be employer insurance It's not a huge figure. It's about less than £100 more often than not. Pensions, very much similar to Singapore. There's an automatic assumption that your employee will be put into a pension scheme, and those pension schemes have to have there is a statutory minimum contribution deducted from the employee and made by the employer, 5 and 3% of gross salary. The employee can opt out, but you still need to do some reporting in regards to that, so you just need to be wary. I don't want to step too much on Antonio's shoes. There is a little bit there on the fact we do need to make sure the proper permits are in place, and actually the salary levels have to, especially with all those tax savings I mentioned earlier, they do get taken into consideration in regards to the visa. So, UK tax in general on the business. If it's a company, the company profits are taxed. If it's a branch, the UK established profits generated from the UK are taxed. So it's all based on profit. And as Vikram mentioned, the UK level is one of the lowest in the G20 at 19%. So it's very much a very attractive offering. And actually, one of the things to also consider, and I mention it later, and Vikram mentioned it as well, is actually when you try and repatriate those funds, if it's a subsidiary, or if it's just a division, you don't have to do a dividend. But there's no withholding tax. So that's quite a key thing based on the double treaty. So you can get taxed at 19% on your profits in the UK, remit it up to the parent company, and it won't be taxed. There'll be no withholding tax. That's not said it wouldn't be taxed in India once it's redistributed, but I would recommend talking to your Indian accountant on that basis. I can't quite believe this is the first time I've mentioned it, but COVID-19. We are watching the Chancellor's moves on what he'll do with corporation tax rates. They are committed to keeping 19%, and actually, we're not sure whether the government want to play around with this, but they might. They're looking at other taxes first on a personal point, so I don't myself see much movement on this, but given this crazy world we're in at the moment, lots of things are happening which I didn't quite expect. There are a couple of very attractive reliefs. I've mentioned the dividend already, and there's a number there which will be which will target a lot of the industries already here today. The one I do want to focus on is IP-based reliefs, 2 in particular. So it's very much intangibles, the creation of IP. In the UK, it's very much a tax-rich asset, and they want to make sure that businesses invest in developing those assets and therefore give quite a lot of relief for it. The headline is that R&D tax relief, if you are developing, and the IP is generated in the UK, it can be you can use partners from other elsewhere in the group. But if the group qualifies under those terms as an SME, actually you spend £100 of qualifying expenditure, you get an additional £130 deduction on your taxable profit. So I have £130 worth of profit. I spend £100 on R&D. Normally you'd be paying tax on that £30. Actually, you get the other £130 deduction. Actually, you've got a tax loss. There's no tax to pay. In fact, now you're making a taxable loss. You can sacrifice that loss and actually get cash back into the UK company. It actually calculates as for every £100 you spend, 33% comes back in cash from the government on those qualifying projects. There's a few bits there on the qualifying costs and a brief example of what I was talking about. So yes, it's very much you are saving either a huge amount of tax, or you're actually getting funding via a tax grant, a cash refund. If you don't qualify for under the SME criteria, there's the large scheme. So that's gone up recently. That was in the budget, it was 12%, it's now 13%. So basically they say, right, you spent £100, £13,000 of that we'll put through as a grant that's due to the company, we'll tax that, but then the net amount we'll give you against other tax. So it's very attractive. The other one I'll touch on very briefly is the patent box. Basically, you have a patent in Europe and the UK. Any profits generated from you selling goods holding that, or services holding that patent, will be taxed at a reduced rate of 10%. You build a widget, you patent the widget, you build a machine which has that widget in, 10% of any profit generated from that machine, taxed at 10%. VAT, again, this is actually, you'll see this more and more actually on your business in the UK. It's 20% and is mandatory for anyone with VATable turnover over £85,000. There have been specific sector reductions given during the pandemic, but as I say, it runs very similar to your GST, though there are slightly different schemes to make sure from a cash flow point of view that the quarterly or monthly or annual payments don't hinder the business. Personal tax is probably the last tax I talk about, honest. It's all about residency, tax residency. Where do you live for tax purposes, and where are you domiciled, where are you from? So each one has a certain amount of regulations and ways it's treated. And actually, if you are moving to the UK, you'll be bringing some capital as well. And it's making sure that's something we call clean capital. So otherwise, once you're in the UK and you remit income that you've generated after you've moved to the UK into the UK, you are taxed on that full amount of cash in the UK, and you may have already been taxed on it elsewhere as well. So it's very much making sure that that setup, that planning for, it may be a founder or a family member of the business who's coming to set it up, is considered at the beginning before you do anything else. A quick plug on capital gains as well. And really just to reiterate why the UK is very much focused on business and entrepreneurs. Capital gains on any gain on a trading sale from a UK tax resident is the first £1 million of that gain is taxed at a reduced rate of 10%. After that, it's 20%. So it's actually lower than you would be taxed on normal income. So it's very much trying to promote the UK as a pro-entrepreneur sector. We've spoken about businesses going to the UK. Well, what about working with UK businesses coming to India, or working with India the other way? I've just put some brief thoughts on there. Make sure if there are any contracts. As I say, I'm not a lawyer. I'm an accountant, trusted business advisor, but not a lawyer. There is contract law there to consider who has jurisdiction on any supplier contracts. Certainly to make sure of that. The place of effective management, it may not be an issue if they're for the Indian business, but it might be for the UK business, and it might be something that actually you want to have a discussion with that trading partner about. VAT, it's more about the place of supply here and whether you're doing it it's a business to customer or a business to business service line. It differs depending on what you do, where you do it, who you do it with. So it's to make sure that any agreements consider VAT, because if not, 20% can be quite expensive. Duties as well. Double taxation relief, yep, it's very much, there are permanent establishment rules in both. There is a long-standing trade agreement between, double taxation relief, the trade treaties coming, I promise. Double taxation relief is to consider that as well. And finally, that little bit there on data protection. In the UK, we've got the General Data Protection Regulations, which came in effect two years ago, and it's all about how you secure and look after the end user's data. And it's quite onerous potentially, and the penalties involved do bite. It is a percentage of your worldwide income, so don't forget about it. And the thing which plugs into that as well, and I know talking to a lot of my Indian businesses, they are very hot on. It's also cybersecurity as well. I know that the Personal Data Protection Bill is still being discussed in the Indian Parliament, but when that comes through, I think it'll probably put things on a far more even footing. Who knows what amendments will get made, but something to consider. Very quick plug on who we are at Moore Kingston Smith. We are a leading accountancy firm based in the UK. We're one of the top 20. We have 8 offices in and around London and the South East, and we focus on entrepreneurs. Businesses looking to grow, not just in the UK, but globally. 60 partners, 500 plus staff. For anyone who could recognise that, that's not the opening scenes of EastEnders, that's actually London and the River Thames. that is where our offices are. We are very much a London-centric firm, but we can cover the wider UK and actually have a lot of relationships with a lot of the areas such as Birmingham, Manchester, Wales and Scotland, where they are very pro-India investment. So yeah, that's where we are. That's a very brightly coloured pie chart looking at generally what we do. We're very multidisciplinary. There's not much we don't do apart from immigration, because Antonio does that far too well. We wouldn't be able to compete. There's then the key sectors that we look after. As you can see, there's not much we don't cover. Technology is one of our core service lines and who we look after. And so we act for some of the bigger boys such as TCS, Infosys and Wipro, but we actually deal with a lot of the smaller businesses as well in establishing their UK operations, and actually watching them grow is why I do this, really. We are part of an international network as well. We do have partner firms in India and also across the world. We're in 609 locations, 112 countries, over 30,000 individuals. So my point very much is there's not much if the UK is just a piece of that global target market for you, let us know, because we can make introductions to people who know elsewhere. And that's our contact details. I'll share the slides with Kishore, who can distribute them, and I shall stop rabbiting on. Thank you very much.